But I do think that right now the market has run up too much. There's too much news, good news, been discounted. I think it's very overdue for some kind of a shakeout. I don't think that is going to be the beginning of a bear market or anything like that, but I think 10% shakeout, 15% shakeout is all possible. And there's a variety of possible triggers. And I think that is actually, if that happens, it actually be pretty healthy to keep this bull market up and running.
What do you think would be the most likely triggers?
Oh, there is lots of things. First of all, right now we're flying in the dark. We don't know exactly how the economy performs, and it could be anything. I'm always concerned about that. Actually, the Fed may not actually deliver the kind of rate cuts as market has discounted. And it could be that the economy turned out to be stronger than a lot of people anticipated, and then all of a sudden, Fed may say, "Hey, balance out the risk of growth problem versus inflation, which is still much closer to 3% than 2." Then the Fed might have to tune down its dovishness, and the market may not like it. Because if you think about the run-up in tech stocks, that is really driven by multiple expansions, and multiple expansions are primarily built on the expectation of falling rates. But if a Fed is not really giving you what market is looking for, then you're looking for some kind of a multiple compression right there. That's one possible trigger. Another one is more on the deflationary side, because we don't know the problem in the so-called shadow banking system. We had two-car auto lenders that actually collapsed. As Jamie Dimon said, that usually you don't only have one cockroach; it could be a whole bunch of them. But the problem here is we don't know the extent of the problem. And the one thing that I'm not terribly concerned about it is that actually, if you think about all this subprime problems, usually it propped up when the Fed was raising rate, but this time around the Fed is cutting rates. So that's probably giving us some kind of a saving grace. May not actually blow up in a spectacular fashion, but I don't think that is something we should take it for granted. It's always that always concerned me. So there are lots of potential problems. The economy is not in the perfect shape, even though the market seemed to be pricing in for some kind of perfection. Back to you.
And yet, I mean, when we would, yeah, absolutely. No, Zhao, you've raised a really interesting issue about the economy, because Marty and I were just chatting about the fact that, when you look at the AI patch, a number of them are making great money, good cash flow, and yet they're not creating jobs. In many cases, they're slashing jobs. Is this something compounded, of course, with what's going on with jobs due to the shutdown, that actually we're going to find ourselves in a really dire situation with higher unemployment, and then the Fed is going to have to sit up and listen?
This is really something that is very, very important. And actually, if you look at the U.S. economy, corporate sector as a whole, the corporate earnings basically exploded upwards by about 80% since 2021, 22. Whereas if you look at employment, private sector employment has only grown about 8%. So that's almost like flattish to nothing. So this is really the first time we saw a sort of a jobless profit boom, or a jobless boom in profits. That, I think, you cannot right now pinpoint exact the reason, but I would suspect that AI, the so-called labor market displacement shock, is one of the reasons. I think the impact will continue to play out, but I do believe over a long time there will be a high-paying, good job being created. But the problem here is the transition. There's a lot of people be displaced. They are not ready for the new job yet, and then you create a huge disparity. On one hand, the corporate profit just going through the roof. On the other hand, you got a bunch of people that are being replaced, got no jobs, and then that really created a huge challenge for the government. How are you going to mitigate this shock? We don't know. We're really in the uncharted water. On top of that, you have this government shutdown. Don't forget, I just checked the September number. September public spending, the total outlay from the federal government basically dropped by 50%. I don't know whether that has anything to do with the shutdown. I would assume that probably partially has something to do with the shutdown. But you have to keep in mind that the U.S. government spending overall account for about 23% of U.S. GDP. So if this shutdown continues, then lots of checks are not going to be written, and lots of bills are not going to be paid, and all of a sudden you might have a demand situation here. So I think there's lots of things that can create an unanticipated shock to the economy that actually is something we need to be really, really careful, because all of this shock could happen at the time when the equity valuation is at a very, very high level. So there's very little margin for the market to absorb all these negative shocks.
Chen, Zhao, couldn't agree with you more on all those points there, right? But it's not just that equity valuations are at such stratospheric levels. It's more that it's not just the tip of the spear now, the Mag 7 and names like NVIDIA. It's like this market is literally standing on toothpicks because the concentration has gotten so acute. NVIDIA accounts for about 8% of market cap. The Mag 7 account for one-third of market cap. So if any of these names in the group stumble, even just trip up a little bit, we've got a big problem. And, this is what we're starting to hear now on the edges from everybody like David Solomon or Ted Pick or the co-CIOs at Bridgewater.
Yeah, that's what I'm saying. If you predict something like 15% shakeout in the next 12 to 24 months, at no value whatsoever. Because as you said, Martin, any of these big companies had 10% correction, you're going to drag down the market in a significant way. But I do want to caution here that actually, if you look at the burst of the bubble, which means the major bear market in technology, the last one at least, last burst of bubble in 2000. As the old saying is saying, the bull markets usually do not die of their old age, but they are all getting slaughtered by the Federal Reserve. So the big trigger for a major collapse in the bubble, that has all come from the Federal Reserve, that has to change its policy, no longer easing, but going back to hiking. So that's when the danger is at a maximum point. But here, I would think that any correction or shakeout is a shakeout. It's not a beginning of a bear market, because don't forget that the Fed is still on the easing path. So that's just something we also need to be keep in mind.